In this video, I'm going to show you how to make a journal entry for a sales return. So let's say that Walmart sells a wedding ring and a bottle of tequila to a customer for $40 cash, and those items originally cost Walmart $25. Now, the very next day, the customer returns both the tequila and the wedding ring for a full refund. So how do we account for this? Well, it depends on whether Walmart uses a perpetual inventory method or a periodic inventory method. And I'm going to show you the journal entries under both methods. So first, to record the sale. If Walmart used the perpetual inventory method, they're going to debit cash for $40, debit cost of goods sold for $25. Okay, that was the original cost of the items. Credit sales revenue for $40 and credit inventory for $25. So this here is to record the original sale. Now, if Walmart used the periodic inventory method, it's not going to record any cost of goods sold. It's not going to reduce the inventory account. However, it's going to debit cash and credit sales revenue for $40. Now let's get to the return. So the customer returns the item the very next day. How do we account for that? So if the perpetual inventory method is used, Walmart is going to need to do a couple of things. First, they're going to debit an account called sales return. Okay, this is a contra revenue account. It's actually going to be subtracted from gross sales when calculating net sales for the income statement. Okay, so you've got the company's gross sales revenue, and then you subtract sales returns, and then you get to the company's net sales. Okay, so you've got sales return as a contra revenue account. You debit that, and you credit cash. Okay, so that's processing the sales return right there. However, you have to put the inventory back on the books. Okay, so Walmart is going to debit inventory for $25, and then they're going to credit cost of goods sold for $25. So they're going to reduce the cost of goods sold expense because now the goods haven't been sold, they've been returned. Okay, so this part of the entry right here where we debit inventory and credit cost of goods sold, that's just to put the inventory back on the books and say, okay, we had reduced the inventory before and we'd recorded cost of goods sold, but now we've got the tequila and the wedding ring back, so we need to put it back in inventory. Now, with the periodic inventory method, if Walmart had a periodic inventory system, then they would not have to make this part of the entry right here where they debit inventory and credit cost of goods sold because they never debited cost of goods sold and credited inventory up here. So if it's a periodic inventory system, all Walmart needs to do to process the return is just debit sales return and then credit cash, and then they're good. Now, this sales return, again, it's going to be a contra revenue account, so it's going to be subtracted when calculating net sales for Walmart's income statement.